$8.6 billion. I mean, think about that for a second. That staggering figure wasn't some massive corporate acquisition or, I don't know, the GDP of a small country. No, that was literally Elon Musk's personal tax bill for a single year, just from exercising his stock options. It's a completely mind-boggling number, right? But it perfectly proves a fundamental truth of the modern business world. What you actually earn is rarely as simple as the top-line number on your paycheck. Whether we're talking about a billionaire founder or a newly minted manager, understanding the hidden mechanics behind compensation is absolutely crucial if you want to build real wealth.
Okay, let's dive right into this explainer. Corporate compensation and tax secrets unlocked. Our mission today is to completely demystify complex salary structures, equity grants, and those exotic fringe benefits you always hear about. We're going to unlock the specific tax secrets companies use to attract top-tier talent and show you exactly how both employees and employers navigate these tricky waters.
To really ground these complex concepts, we're going to follow a super relatable career transition. Meet Julie. She's a highly successful executive who just landed a lucrative new job offer to become the VP of Marketing at Technology Products Inc., or TPI. Now, her offer letter is basically split into three main buckets. We've got a solid base salary of $280,000, a generous package of equity grants, and some very attractive fringe benefits. Understanding exactly what each of these components means for Julie's personal bottom line, and honestly for her new employer, is the whole key here.
Let's start with the most familiar bucket, right? The basic salary. But even here, there are two wildly different perspectives. From the employee's view, your salary is taxed as ordinary income the second it hits your bank account. You see your paycheck and you instantly see the taxes ripped right out of it. But from the employer's perspective, that exact same salary is a vital tax deduction. To them, it's a business expense. When a company pays you, it actually lowers their overall taxable income. So the after-tax cost to the company is actually a lot less than the total salary they're handing you.
But wait, here's a fascinating catch. The IRS actually puts a hard cap on how much a publicly traded corporation can deduct for its top executives, for what they call covered employees. So we're talking the CEO, the CFO, and the next three highest paid officers. That tax deduction is capped at exactly $1 million. Literally anything paid above that $1 million mark, completely non-deductible for the corporation.
And this brilliantly illustrates how that cap completely changes the corporate math. Let's look at Julie's potential new CEO, Daniela Hewitt. Say Daniela negotiates a $1.5 million base salary plus a cool $1 million bonus. That's $2.5 million in total comp. Well, because of that IRS cap, the company can only deduct $1 million of it. That remaining $1.5 million offers zero tax savings whatsoever. Because of this, the company's true after-tax cost for paying Daniela skyrockets to over $2.2 million. It's a seriously heavy corporate price tag to secure top-tier leadership.
All right, moving on to Section 2, the stock option gamble.
Now, what's really interesting about this slide is the core engine behind equity wealth. Equity-based compensation is where regular, everyday employees can literally transform into millionaires, but it's also where the tax traps are the absolute most dangerous. And it all comes down to something called the bargain element. When you get a stock option, you're getting the right to buy company stock at a fixed, usually heavily discounted exercise price. Years later, if the company crushes it, the stock's actual market value is going to be way higher. The difference between what that stock is worth on the open market and the discounted price you get to pay for it, that's your bargain element. This exact mathematical gap is what creates massive personal wealth, and as you'll see, some truly staggering tax bills.
Let's look at Julie's offer. It includes two major types of options. First up, we have non-qualified stock options, or NQOs. With these, that bargain element we just talked about is taxed as ordinary income on the exact day you exercise the option to buy the shares. Employers absolutely love NQOs because they get a matching tax deduction for that exact same bargain element. Then, on the flip side, we have incentive stock options, or ISOs. Employees generally vastly prefer ISOs because the tax is actually deferred until you officially sell the shares. Plus, if you meet certain holding periods, your profits get taxed at the much lower long-term capital gains rate. The catch? Employers get zero tax deduction for ISOs, which is exactly why they tend to hand out far fewer of them.
Walking through the life cycle of an option really reveals exactly when these taxes hit. It's kind of like a giant ticking clock. In year 1, the grant date, you get the options. Nothing happens. No tax consequences yet. Then let's say year 3, the vesting date. You finally earn the legal right to actually use them. Still no tax. But year 6, the exercise date, that is the moment of truth. You hand over cash to buy the stock. If these are NQOs, boom,
This is a major taxable event. You owe taxes on the bargain element immediately, even if you haven't sold a single share. Finally, we hit year 8, the sale date. You sell the stock on the open market, triggering capital gains taxes based on how much the stock went up since you bought it. To really see the extreme scale of this mechanism, let's look back at Elon Musk's 2012 Tesla NQO plan. At the time, the stock was really struggling, so his exercise price was set incredibly low. Over the next decade, as the stock basically escalated into the stratosphere, that bargain element grew to over $1,019 per share. So when he finally hit his exercise date, the IRS came knocking for its cut of that ordinary income. That math worked out to $377 in taxes owed for every single share he acquired. And that is exactly what scaled up to create that massive $8.6 billion tax liability we were talking about at the start of the explainer.
Let's move to Section 3 and see how this builds: restricted stock and the 83B hack.
So, another form of equity in Julie's offer is restricted stock. Now, unlike options, with restricted stock, you aren't just given the option to buy shares. You receive the actual shares outright, right off the bat, but with some major strings attached. You don't truly own them until certain timeframes or performance goals are met. This completely changes the tax timeline. At the grant date in year 1, you get the shares, but you can't sell them. Then comes the vesting date in year 2, where those restrictions finally lapse. Here's the absolute kicker. Employees with restricted stock are taxed on the full fair market value of the stock on the exact day those restrictions lapse, and it's taxed as ordinary income.
But what if I told you there is a strategic tax hack here? It's known as the 83B election. The standard path, like we just saw, is to pay zero tax at the grant date and then get hit with a heavy ordinary income tax on the stock's full, potentially way higher value when it vests. But if you make the 83B election within 30 days of getting the grant, you voluntarily choose to pay ordinary income tax immediately based on the current lower value of the stock. By paying a little bit of tax up front, you magically convert all future appreciation of that stock into long-term capital gains, saving you a massive amount in taxes down the road. It's essentially a calculated gamble on your company's future growth.
Now, I got to make a quick note on a very popular variant you've probably heard of: restricted stock units, or SRUs. These are heavily utilized by major tech giants. Think Apple and Amazon, mainly to ensure long-term employee retention. SRUs are valued in stock at the grant date, but the actual shares, or sometimes just a cash equivalent, aren't distributed until they actually vest. Crucially, because you don't receive actual stock at the grant date, the IRS says, nope, no 83B tax hack for RSUs. You will always, without exception, pay ordinary income tax when those RSUs vest.
All right, shifting gears. Section 4, the world of fringe benefits. When you're navigating the exotic world of fringe benefits, you absolutely must remember the golden rule of the IRS. Basically, everything you receive from your employer is considered taxable compensation unless Congress has specifically written a law to exclude it. Generally, we can drop these benefits into 2 buckets. Taxable fringe benefits are usually your luxury corporate perks. We're talking auto allowances, high-end gym memberships, or, flying on private jets. Because they aren't explicitly excluded by law, you pay regular income tax on their value. On the other hand, non-taxable fringe benefits are usually your everyday necessities or things linked to public policy. Think health insurance, educational assistance up to a specific limit, and even basic employee discounts. For these, you get the full value of the perk, but pay zero tax. To see taxable benefits in action, we really just have to crack open the SEC filings of major public companies. Take this excerpt directly from Comcast's 2023 proxy statement. It's talking about their executives using the company aircraft. It states super plainly that these officers are imputed income for the costs related to their personal flights. What does that mean? It means even billionaire executives face heavy tax liabilities when they take the corporate jet for a quick weekend getaway. The IRS treats that flight exactly like they just handed them a massive cash bonus.
But hey, it's not just private jets, right? Even standard everyday benefits can hide a nasty taxable surprise. Let's look back at Julie. She gets a $750,000 group term life insurance policy. Sounds great, except Congress only excludes the first $50,000 of coverage from taxes. For the remaining $700,000, we actually have to step through a specific IRS formula based on age brackets to calculate a phantom value. So, because of this, Julie is going to have to add several $100s to her taxable income every single year just for holding this company-provided policy. Crazy, right?
And the line between what's taxable and non-taxable is constantly being debated. For example, consider those legendary gourmet cafeterias at Silicon Valley giants like Apple, Google, and Facebook. Are these lavish free meals a taxable luxury perk? Or are they a non-taxable benefit provided strictly, quote, for the convenience of the employer? The companies argue that keeping employees on campus to eat fosters collaboration, keeps them at their desks longer, and makes it a pure business necessity, not taxable income. It's an absolutely fascinating tax gray area that the IRS is constantly eyeing.
We can actually play a rapid-fire game of taxable or non-taxable right now by looking at the actual documented perks of Disney CEO Bob Iger straight from their proxy statement. A massive $800,000 personal security detail? Taxable. Personal use of the corporate aircraft? Taxable. But what about complimentary access to Disney theme parks for his family? Well, that's actually a non-taxable, no additional cost service. And discounts on Disney merchandise? Also non-taxable, because it falls under the qualified employee discount rule.
So the crucial point here is how we use all these rules to actually optimize compensation. Look at this conversion strategy. If Julie wants to take some marketing classes, her new company, TPI, could just pay her $6,579 in extra taxable salary. After she pays her 24% tax rate, she's left with exactly $5,000 to pay her tuition. And the after-tax cost to the company is over $5,000. But if the company simply provides a $5,000 non-taxable educational assistance benefit instead, Julie gets the exact same $5,000 in value, and the after-tax cost to the company drops to under $4,000. Mathematically, swapping taxable salary for non-taxable benefits enriches both the employee and the employer. It's a total win-win.
And that brings us to the most important question for you. When you look beyond your own base salary, are you leaving massive tax advantages on the table with your current compensation package? Whether it's truly understanding the bargain element of your stock options, utilizing that 83B election hack, or negotiating for highly efficient non-taxable fringe benefits, the true value of your work is defined by what you keep, not just what you earn. So I challenge you, go audit your own job offers, scrutinize your pay stubs, and leverage these exact rules to optimize your next big career move. Until next time, keep learning.